Okay, so let's go ahead and let's take a look here. And we have this company that just started operations for the first time this year. Okay, and what we're going to do is we're going to record our journal entries, and we record our journal entries in the journal, right? Record our journal entries in our journal, and then we're going to post them to the ledger, right? So first we record something in the journal, then we post it into the ledger. And so we're in our journal over here where I just highlighted. And remember, we've said now several times, assets equal liabilities plus what? Plus our stockholders' equity, right? And that equation always has to stay in balance, okay? So we go ahead and we have our ledger accounts under here. We have our cash, we have our equipment, we have our building. Those are all assets. We have our mortgage payable is a liability, vehicle payable, right? Our liabilities over here. And so we go ahead and we debit cash for $1 million. We post that over here in our ledger, and so that is a debit to cash. It is an asset, so when we increase it, we debit it, right? And we end up with a balance here of $1 million for our cash, right? Now we have to make a credit, and so we come over here to our common stock, and we credit our common stock, and now it has a balance of $1 million. So at this moment, our balance sheet balances, doesn't it? Assets are equaling our, we don't have any liabilities, so it equals our common stock. Okay, good. Then we've purchased a building. Okay, and the guy said, "Hey, I want 1.2 million for the building." We said, "Well, we don't have 1.2 million. How about we give you $1 million down payment, and then we'll pay you the rest later?" So we have another bill, don't we? Or now we have a bill, a liability. Okay, and so what happens when we do that? We go ahead, we give up our cash. So now the cash balance is what? Is zero because we credited cash. To decrease an asset, you credit it, right? So we credited the cash, and we are going to debit the building for the full amount of the building, 1.2 million. And all I'm doing is I'm taking this general journal entry and I'm doing what? I'm going ahead and I'm posting it to the ledger, right? And then we go ahead and we post the credit to the liability, mortgage payable. Our assets are still equaling our liabilities plus our stockholders' equity, right? We don't have any more cash, but we have a building that's worth 1.2 million. We have our what? We have our common stock for 1 million. We have our now liability 200,000, still equaling, right? Okay. Okay, good. So then we go ahead and we need a vehicle. I think we said we had a DJ business or something. And so for what? For that equipment, that van, that delivery van, we want 150,000. They want 150,000 for it. We told the guy, well, we don't have any cash. He says, that's okay. You can just pay me later for the entire amount, right? Okay, so we go ahead and we debit the equipment. He got us the equipment, and we go ahead and we credit the vehicle payable for 150,000. Assets went up, liabilities went up, right? Okay. Okay, good. Then we go and we get our first DJ gig, and the guy just pays us straight out 200,000 cash. Okay, pretty good gig for us, right? He just gives us 200,000 cash. We don't ask him where he got the cash or anything, but he goes ahead and he hands us that cash. And when we do, we debit cash, and the cash balance comes up 200,000 now, doesn't it? Okay, and now we have a revenue. Now, the reason I put revenues and expenses under stockholders' equity, they are income statement accounts, not balance sheet accounts, but we will eventually, when we get to the end of the year out here, close out our revenues and our expenses into retained earnings, so they will eventually affect our stockholders' equity, right? So that's why I stuck them down there, just so that our equation stays in balance. Revenues equal assets plus assets equal liabilities plus stockholders' equity. Okay, good. Now we have to pay, and I don't know if on the video or last time I said that we have to pay cash we have to pay our, I think I said gas or something, okay, but I didn't read it carefully enough. It's what? It's salaries, but that's okay. It's still an expense, isn't it? Okay, so we have an expired cost and expense. We debit the expense for 70,000. That brings the balance up to 70,000 over there, and then we credit cash for 70,000, and that brings my cash down to 130 now, right? Okay, so I've gone ahead and I posted my transactions into my ledger as I went through. And if we were doing this by hand, we might do this once a month. We probably wouldn't post each transaction each time. We're going to see that in an automated general ledger system, we're going to go ahead and we're going to see that the automated system will do it automatically. Question, guys? Okay. All right. So now that we've got this, we're going to go ahead and we are through with transactions for the year. We should be able to go ahead and pull our income statement now, right? So we go ahead and pick up our pen here, and let's start with, and I'm just writing it here because there's space here. I'm going to go ahead and do my income statement. Let me erase that. I'm going to go ahead and I'm going to put together my income statement. I'm going to do it right here, I guess. Income statement. I'm just doing it here because this is where I have room to write it. Obviously, we'd have a fresh piece of paper. We wouldn't write an income statement in the middle of our ledger, right? Okay. And so our revenue here, and we just start to pick up the amounts in the ledger accounts. How much is the revenue? How much is the revenue? 200,000. So we go ahead and we report revenue 200,000, right? See how easy accounting is? You make the entries as you go along, and then you just sit there and you pick up the accounts at the end of the year that you want to put in there. How about my expenses? Do I put expenses on my income statement? Okay. So my expenses are 70,000. Thank you. Okay. Where'd I get that? Just picked it up right there off the ledger, right? 70,000. So I'm sitting here and I have net income for what? 130,000? Revenues minus expenses. Okay, and I'm just going to put a little parentheses around there to show that we're subtracting that. You probably wouldn't show it that way right on the face of the income statement. Usually they just show revenues, expenses, and they show you the difference is your net income. So now that I have that 130,000 as my net income, I'm going to go ahead and I'm going to prepare my statement of retained earnings. And since I just started business, my beginning balance in my statement of retained earnings is how much? Zero. Good. This is my first year in business, so that's starting with a zero. And then I have net income, don't I? And so as I show my net income down here, I'm just going to put NI. Net income is 130,000, right? With me so far? Okay. But I've got to pay that voice that came and gave me the money to start this business or whatever. I don't know it's common stock, but I've got to pay a dividend, and I don't have to pay a dividend, but I decide I want to pay a dividend, and I'm going to pay a 10% dividend here. So since I'm paying a 10% dividend, I'm going to debit dividend 13,000. There's that. And I, of course, am going to pay them out cash, so I'm going to credit my cash for 13,000 for that dividend that I just paid them, right? So now I can sit there and say, okay, well, I didn't retain all of my earnings. I distributed 13,000 of it in the form of a dividend, right? Okay. So I go ahead and I report that dividend less, what is this? Less, no, why is it wanting to do that? Get out of there. Pen got to come back, I guess. Less dividend, right? How much is the dividend? 13,000. And when I subtract off that dividend of 13,000, now my ending balance in retained earnings is what? 117,000? With me so far? Okay. Now I prepare that statement of retained earnings there like that, showing you my beginning balance was zero, my net income was 130,000, my dividend was 13,000, so my ending balance is 117. But accountants just don't say amounts in accounts unless we actually can see those in our ledger accounts, right? So now we're going to go ahead and we're going to make sure that our ledger accounts are tying to what we're showing here for our retained earnings, right? Okay, so what we start to do, guys, is we start to sit here and make a series of closing journal entries. And we're going to close these accounts now that were our revenue and expense accounts for the year. So because we're sitting there with a balance of how much in revenue? 200,000 sitting there in revenue. To close that, to get it to zero, I will debit revenue for 200,000. And when I do, this thing has the zero balance in it, doesn't it? And I want it to have a zero balance at the end of the year so that next year I can go ahead and do what? Start to accumulate the revenue for year two, right? I do my revenue a year at a time, just like when they say when you're sitting there and you get your pay stub, the last pay stub of the year has all the revenue that you made for the entire year, and then next, that's the second year two of your pay stub, it starts at zero again, doesn't it? They start to accumulate your revenue by year, okay? So I go ahead, I debit revenue, and I credit an account called income summary. And when I credit that account called income summary for a second, income summary comes up to a balance of 200,000, doesn't it? Okay. Okay, good. Then what? Then I want to close my expense accounts. I track those by year, so I want that to be zero at the end of the year. So now I credit my expense account. Is it zero now? Where I wanted it to be? It's zero. And then I go ahead and I do what? I debit income summary, and now income summary has 130,000 sitting in there, right? Okay, so what do I do now? Well, I want income summary to be zero because I track my income by year, don't I? So I want that to be zero next year so I can track my income over there in the next year. So I go ahead and I debit income summary 130,000 and I credit my retained earnings account. When I debit income summary, is it zero where I want it to be? And my retained earnings now has what? My retained earnings, and I wish I would have written that 13,000, the dividend, one row lower, but just ignore that it's there and just pretend like it's not sitting there and it's one row lower. But when I credit retained earnings, right now it's got a balance of 130,000 in it, doesn't it? Okay. And then what? Then I just have to close my dividend account because I keep track of my dividends by year. I want to know how much I paid each year for a dividend, assuming I pay a dividend in a given year. And so to do that, since it has a debit balance of 13,000, I'll credit it 13,000. Is that closed now? That one is now zero. And I do what? I debit my retained earnings 13,000. I wish I would have written that down here, but that's okay. It was 13,000. I'd put the debit and the credit on the same row. I didn't want to do that. But that's okay. When I debit it, this is now 117,000, isn't it? Does my statement of retained earnings look right now? Does my statement of retained earnings look right now? Guys, is there a question or is there a translation of some sort going on there, or what's the question? Because I'm trying to figure out why there has to be an interpretation of everything I'm saying from one person to the other. No, I'm serious. I mean, if there's a question, I'll answer it. Is there a question? Okay. Okay, good. So what's going on there? Then I'm ready to prepare my balance sheet, and I'm kind of out of room on this thing to prepare my balance sheet. Why don't I just come up? Maybe I'll find some space up here. Yeah, I can go ahead and squeeze in my balance sheet now. And I'm going to put my balance sheet, I guess, right here, I guess. Where am I going to put my balance sheet? There's no room. Oh, okay. Do I have room over there? Oh, okay. Thank you, sir. Okay, so I can put my balance sheet here. Just like watching a rerun, right? Okay, so I go ahead and I put the balance sheet over here. And I'm just going to pick up my balance sheet accounts. Is cash a balance sheet account? So I have my cash. My cash was what? At the end of the year was, no, it was 117. It was 130, and then I paid the dividend of 13,000, right? So it's 117. Okay, good. How about any other? How about the equipment? I'm just picking up the asset accounts now. How much is in my equipment? 150. Okay, good. And here's my building, 1,200,000. Okay. And so that's 1,200,000. And any more assets? That's it. Did somebody have the check figure on that? Total assets, 1 million. Tell me again. 467,000. Okay. Okay, good. There's my assets, right? Now I got to pick up my liabilities. Comparing my balance sheet. So my mortgage payable, I'm just going to put MP here. Mortgage payable is what? 200,000? Okay, good. How about my vehicle payable? I'm just going to put that as VP. Vehicle payable is 150,000. Okay, good. Any more liabilities? That's it. So my total liability is 350,000. Okay, good. Now what do I need? Stockholders' equity? Stockholders' equity we know is common stock and retained earnings, right? That's it. So common stock is 1 million. Where am I getting the common stock number? In the common stock ledger is 1 million. And my retained earnings is how much? 117,000. I'm picking that up from the ledger. So my total stockholders equity then is, even I can do that one in my head, is 1,117,000, right? Okay, good. So what's my total liabilities plus my stockholders equity? It better be, right? Or I've got some explaining to do. 1,467,000 is the total. Okay. Don't you love accounting? It's always going to work, guys. If you sit there and you debit and you credit correctly as you go through, you can't miss in getting your financial statements correct. And we're doing this like as though it's 1970. I mean, I should be smoking a cigarette indoors while I'm doing this thing, right? The reality is that we're going to look at the general ledger software here and see how we would handle this whole thing through a general ledger software that accountants would use. All right? Question on that? Yes, sir.
Why do the retained earnings get to go under the stockholders' equity on
Because
your balance sheet?
that's where it belongs. That's where it's supposed to be. It's equity. It's what I have left of my earnings for the period. It belongs under stockholders' equity.
I have a question in a what if scenario. So what if after you provided the service, they had paid you on account?
Okay, well, let's get into year two then. Okay, and we're going to see that we're going to have some of those things coming up in year two. Okay, so we come over to year two, and one of the key things that we have to look at is first off, the beginning balances carry forward from year one for our balance sheet accounts, don't they? So we had 117,000 cash. We had the equipment was 150,000. We had the what building was 1.2 million. Okay, we come over. Some of these other accounts that you're seeing now weren't there at the end of last year. We're going to add some additional accounts this year. The mortgage payable still had 200,000. The vehicle payable still had 150,000. Our common stock had 1 million. Our retained, I didn't put beginning balance, but that would have been the beginning balance. The retained earnings still had what? 117,000 sitting there, didn't it? Right? And then what? My revenue and my expense accounts, by definition, guys, need to be zero. Those are my income statement accounts, and I keep track of my income by year, don't I? So everything's starting out at zero. These other transactions that you see underneath beginning balance are just going to be your two transactions. I don't want to sit here and have to put them in one at a time while you sit here. So I've already stuck them in there, but we're going to follow through how they would have gone through, right? Okay. Okay, good. So we come over and we take a look at our journal. And in our journal, we go ahead and service is provided on account. That means that we provide the service, but the guy tells us, I'll pay you in 30 days. And we look at this and we say, okay, well, that's not bad. The dude's going to give me 100,000. Okay, yeah, pay me in 30 days, not a problem, right? Okay, because he's going to cough up 100,000. In fact, maybe we're doing a gig in a neighborhood where we'd rather not have him hand us the 100,000. We say, hey, just send us a check in 30 days. We got you. We got you, okay? So what happens? We go ahead and we debit the cash for the 100,000. Um, I mean, we didn't get cash. What am I saying? We debit what? We can't debit cash, so we have to debit the accounts receivable, which is an asset for 100,000. It has future economic benefit. That money's going to come in 30 days, right? Okay. Guys, this is not the time to practice your comedy chops because the person sitting next to you maybe don't want to hear your joke, and what they want to hear is what I'm saying up here. So just kind of hold it for after class. There'll be plenty of time. Okay. Then what? Then you come over and we credit the revenue for 100,000, don't we? So now we've got revenue cooking in year two, don't we? Okay. Okay, good. Then we come back and we take a look and we realize that we're driving our vehicle without insurance. Are you supposed to do that? So we say, you know what? We better get some insurance in here. So we go ahead and we debit the prepaid insurance, and it's a 2-year policy. We buy it on January 1st. So we've got 2 years of insurance coverage now, don't we? Is that future economic benefit? When you pay your insurance in advance, good. You have future economic benefit. So that's an asset. So we go ahead, we debit the prepaid insurance, and it comes up to 1.2 million. So now we have that asset. We paid them in cash, so we credit the cash. So our cash balance comes down. Cash is an asset. When you credit it, it decreases, right? Okay. Okay, good. Then we go ahead and we sign a 1-year contract with this guy, and he says, yeah, come and play at my gig. And we sign it on July 1st, and he says, the way we're going to do this is it's a gig a month for $10,000. So that's where we got this 120,000, right? And we tell the guy, no problem. This is a pretty good customer, right? And he says, but make sure you show up. Because if you don't show up to the gig, you're going to ruin my party. I'm going to have my boys come talk to you, whatever, right? So you're like, oh, we better show up, right? So what happens if we don't show up? Do you think we're going to have to give this guy his money back? We're going to have to give him the money back. So we have a bill, we have a liability right now because there's a potential that if we don't earn the revenue, we'll have to pay that back. So that's a liability. So we go ahead and we debit the cash here for the 120,000 that he just gave us. My cash balance comes up because this is an asset. I debited, it increases. And I come over and I do what? I credit my unearned revenue. Unearned revenue is sitting where? Sitting under my liabilities. Unearned revenue. If you haven't done the work yet, that's a liability, right? Okay. Okay, good. So then what happens? Then we realize we need some supplies. I don't know what kind of supplies a DJ business would use. We need some, I don't know, we need some, huh? Well, this is not machines. We want supplies. Okay, it's not equipment. I don't know. We buy some cleaning supplies because somebody threw up on our equipment last time. I don't know. We're just gonna sit there and we want to clean up. Sorry, guys. Okay, so we're gonna go ahead and we're gonna clean that up, right? I mean, we're gonna buy these supplies. So when we buy the supplies, we go ahead and we debit supplies, and those supplies are going to last us for a while. So we debit our asset supplies for 24,000 because we are going to be able to use those for a little while, aren't we? Okay. And so then what? Then we credit accounts payable because when we go to the supply store, the guy says, oh, yeah, I remember you. You're the DJ guy. Not a problem. Go ahead and pay me in 30 days. And he sets up an account with me, so maybe I'll keep doing business with him. So I'm going to have a bill there, right? A liability that I have to pay him. And when I credit that, my accounts payable goes up to now 24,000. Okay. Yeah, I could say purchased on credit. I mean, I'd have to tell you something so you know that it's a payable, right? Yeah, so we could say that on credit. Yeah, we'd have to give you some indication as to what it was. So we could say on what? On credit, okay. You could say that you purchased it on account. Okay, and if you're purchasing on an account, now it's what? Now you have an account with them, or we give an account to other people, right? If we give an account to other people, that's a receivable. If we are on somebody's account, that's a what? That's a payable, right? You've seen that. If someone, in the movies or something, some guy will go to a bar and he says, "Put it on my account," right? And that means he's going to pay it later or whatever. Okay? Okay, good. So you come over, and what happens? Now we're going to collect some cash on this receivable. Remember the guy said he would pay us later? So he says, "Hey, I got 40,000 for you. I'm just going to send it to you." We say, "No problem." So he sends me the 40,000 cash. I collect that on the account receivable. And when I do, I go ahead and I debit the cash for 40. Cash is an asset, so it's come up now. And I have now paid down some of that receivable, or I've received some money on the receivable. They've paid their balance down. So he's paid me 40,000. He still owes me 60, doesn't he? The whole point of accounting is this right here. So if the guy calls me up and says, "Hey, how much did I owe you again?" We can tell him in a second with the press of a button, "You owe me 60,000 still, right?" Right? Okay. Okay, good. So we go ahead, we do that, and then we come to December 31st. And at December 31st, we say, "Okay, we have done 10 gigs. I mean, not 10 gigs, 6 gigs already, right?" Because not gigabytes, but music gigs. Because what? We sat there and we got on July 1st, the 120,000. It was a gig a month. So we've earned 6 of them now, haven't we? Okay, so what do? We go ahead and we now can coming over, debit that unearned revenue for 60. There's 60,000 left, right? And we can credit the earned revenue for 60,000. So there was that cash one, and there was that one that they had paid me the cash up front, and then there was the other one. I mean, there was the one where they didn't pay me the cash up front. That was the 100,000, and he paid me over time. The other one, he gave me the cash in advance, and as I earned it, I took that revenue, right? So the receipt of cash is not what causes me to generate the revenue, right? It was what? The performance of the service. In one case, they paid me later after I performed the service. In the other case, what? He paid me up front and then I performed the service, right? And I didn't recognize the revenue until I had actually performed the service, right? Yes, sir.
So every month that you perform from the 120,000, the liability goes down 10,000?
Theoretically, I mean, we waited till the end of the year to adjust it here, but yeah, it would have been $10,000 a month. The liability would have gone down, and the revenue would have gone up if I had done this monthly. In this case, I just waited till the end of the year to do it.
So the liability shifts to assets in that case?
No, the liability switched to revenue. I debited the liability for 60,000, and I credited the revenue for 60,000. Right? Okay. Okay, good. So then you come over, and you take a look, and come over, and now I have to accrue 1 year of expired insurance. Remember, I bought a what? I bought a 2-year policy, didn't I? And I bought that for 1,200 on January 1st. Well, now a year has gone by, so half of that has expired, hasn't it?
Yeah.
600 has expired. So I go ahead and I debit my insurance expense right here. Okay, again, this is my journals, and then I post over to my ledger. I sit here and I debit my insurance expense for 6,000. What I do? Skip some ones or something? Or I just did them in a not 6,000, but what?
600.
600, and then I come over and I do what? I credit my prepaid insurance because what? $600 of that asset has expired, hasn't it? It's expired, and so I took the expense, I reduced the asset by the portion that has expired, right?
Yeah.
Okay. Okay, good. Then what? I guess my posting went a little out of order there, but that's all right. Then what? Then I go and I count the supplies. And when I count the supplies, I count that there are, what is it, 13,000 left?
Yeah.
Count of supplies show that there's 13,000. Well, if I had 24 and there's only 13,000 left, then I must have used 11, right? If you had 24,000 apples at the beginning of the year and then you look at the end of the year and there's only 13,000 apples left, you must have ate 11,000, right? Okay, so in accounting, we just don't say, well, subtract. We use debits and credits to add and subtract. And so we're going to go ahead and we're going to credit the supplies for the 11,000 that we must have used. We're left with 13,000, aren't we? Don't you love accounting? Isn't it perfect? Look at this. It's a perfect little universe here. We debit the 11,000 for the expense, right? Okay, and our balance goes up in the 11,000. We kind of went a little out of order here in how we went through these. Now, I'm not going to get too much into depreciation right now for us. We'll deal with it later. Just know that for the building, we would take some depreciation, okay? And when we take the depreciation off the building, that means the building's getting a little older. And so after 1 year, the building's not quite as shiny and new as it was when we first bought it. So some of that building has expired. So we go ahead and we debit the expense to recognize that portion of the building that is expired, that little wear and tear that has come onto the building that is expired. We debit that expense and we credit accumulated depreciation. The accumulated depreciation is going to be an amount that reduces the total value of my building. But rather than just credit it straight to the building account, I credit it to an account called accumulated depreciation. And we'll talk more about that. That's somewhat up the road for us a little bit, but I wanted to start to introduce that notion to you right now for the building. Okay? Okay, so what's happened? We are finished for the year with our revenue and our expenses. So can we prepare our income statement? Let's see. Maybe I'll put the income statement over here this time. Looks like I have room. Income statement. Do I have revenue? Do I have revenue? I have revenue of what? 160,000. Do I have expenses? I have expenses of what? 61,600. Just pick them up right off the ledger accounts, right? 61,600. Good. So my net income is how much now? Somebody got a number for me for the net income? 98,400. Hello? Okay. Revenues minus expenses, 98,400. Right? Okay. Now I'm ready to do my statement of retained earnings. Did I have a beginning balance for retained earnings? My beginning balance was what? My beginning balance, are you guys following this? Okay, my beginning balance was 117,000, right? So the beginning balance is 117. Then what should I add to that? What do I add to my retained earnings? My net income has to be added to my retained earnings, so I'm just going to bring it down, 98,000. Did we pay any dividends? There was nothing indicating that we paid dividends, and you don't have to. The company doesn't have to pay dividends. This is something that we decide, right? Maybe if the voice calls us back and says, hey, where's my dividend? We say, hey, we're saving some money because we need to buy some equipment down the road or something, and so we're saving up some money. Don't worry about it. We'll get back to you later with a dividend, right? You don't have to. And so I go ahead, I add my net income, right? That's an add. And the ending balance in the retained earnings now becomes what? We add those two numbers together. It is how much? 215,400. Okay, good. But before we finish the year now, before we can prepare our balance sheet, we need to go ahead and do our closing entries, don't we? This is year two. We're going to close again. So because our revenue account has what? Has this 160,000 credit sitting in it, right? We want to debit it so that it zeroes out. So we debit our revenue for our 160,000. When we do, does it go to zero? Is it zero now? Excel to just put a line there, and I forgot to put a zero in there, but that's zero. And then what? we credit income summary, just like we did. This is, if you're having deja vu, if you think you're having deja vu, you're not. This is what? Same thing we had done last year, right? We go ahead and we credit that into the income summary, 160,000. We go ahead now and we close our expenses. Since there's a balance in there of 61,600 debit balance, we want to close that, so we credit our expenses, right? Credit our expenses for 61,600. We have to now debit income summary. We come over to income summary, we debit it. It has a balance in there of 98,400. We want to close that out, don't we? So we debit income summary, 98,400. We credit the retained earnings now, 98,400. Post those over in the ledger, and now the retained earnings has the balance, 215,400, right?
Yep.
So we're ready to prepare our balance sheet.
Yes.
Okay, so let's go ahead, let's prepare our balance sheet. We have cash. How much is the cash? It's looking up. It's what, 275,800? That number right there. Okay, so I'm just going to go back down. I probably should have put it over on the other side, but that's right. 275,000, how much? 800. Okay, good. Any more assets? I still got that equipment for 150,000, right? So the equipment, what was it? 100 and 150? Good. I still have the building, don't I? Okay, so the building is 1,200,000. But what I would do is I would actually report a subtract for the accumulated depreciation of 50,000. The reason I do it this way, you say, well, why don't you just reduce the building, John? Why don't you just credit the building? Because the accounting standards want us to show the users the financial statements. This is what I paid for the building. This is how much I've used it, right? And I've only used it for 1 year so far, so it's only 50,000. And as the years go by, that accumulated depreciation number will decrease. So that 50,000 is a subtract, isn't it? From the building? Okay. Okay, good. Then what? Then I have accounts receivable. I'm going to run out of room here on this side. I have accounts receivable. My accounts receivable is going to be what? 60,000?
Yep.
Okay, good. And I have the supplies, the ones that were left. I don't know why it keeps changing on me. So I have the supplies that are left. Supplies are what? 13,000? Just picking that up. And then I have my prepaid insurance. The prepaid insurance now is going to be what, $600?
Yep.
Okay, any more assets? Any more assets?
Nope.
What's the total assets now?
Just had a question. I can't really see it from here. Right underneath cash, where's that stand? That's an I. What is that?
Equipment.
This one right here?
Yeah, equipment.
That's equipment, EQ. Yeah, EQ for equipment.
1,609,000
1,609,000.
and $400.
1,609,400.
Yep.
Do I have a verification on that number?
Yep.
Okay. Okay, good. So we're good on that. Okay, I'm going to put the liabilities over here. I probably should have put the whole thing on this side, but I'm just going to continue the liabilities because I'm running out of room. I'm at the bottom already. And so my liabilities, now I go through my liabilities, right? And in fact, let me write that whole thing a little higher. I don't know why I keep hemming myself into small spaces here. And so let's just go ahead and let's do the liabilities. Okay. So liabilities. Okay. I don't know why it's doing that. But liabilities, we have the mortgage payable still.
Yeah.
guess as long as it comes down to where we want it to, that's okay. The mortgage payable is 200,000.
Yep.
That's the weirdest thing I've ever seen. Okay. Okay, and how much is the vehicle payable? Vehicle payable is 150,000. Finally, this whole exercise got entertaining, right? Look at this stupid thing. Okay, 150,000. Okay, then what? Accounts payable is a liability? 24,000. It's always got to be something, doesn't it? Okay. And any other liabilities?
Unearned revenue.
The unearned revenue. Unearned revenue, Jesus, is what? 60,000? Any other liabilities?
Nope.
So my total is how much? 350 plus 24 plus 60 is
434.
434,000. Okay. Okay, good. How about my stockholders' equity then? And my common stock is what? A million? Six. It's a million. And my retained earnings is how much? How much is my retained earnings? 215,400.
Yep.
Okay, good. And my total, what? Even I can do that one in my head, is what? Total stockholders' equity is 1 million. Oh, good, it stopped that stupid thing. Is 1,215,400.
Yep.
Okay, good. So what's my total stockholders' equity plus liabilities then? 434 plus 1,215,000 is how much?
1,649,400.
1,600 and what?
49,400.
Okay, somebody gave me a wrong number on one side or the other. Do I have to add it up myself, I guess? Okay. So I have cash of 275,800, right? And I have equipment of 150,000. And I have what? Accumulated depreciate building of 1,200,000,
Yep.
right? I have a subtract of 50,000 for the accumulated depreciation. I have 60,000 of accounts receivable, right? 275,000.
I got it already.
What's the total?
1,649,400.
16 what?
1,649,400.
49 1649,400.
Yeah.
Okay, 1649,400. And what was the total over here?
Same.
1649.
Same.
1649,400.
Yeah.
Okay. Okay, so we have the same number, right? We better have the same number, or I probably would have gone ahead and had a heart attack. Just got it over with. Okay, so that's the same number, isn't it?
I think it's off by $400.
Oh, well, prove it to me. Okay, so it balances. I did the same exercise last night, guys. There's no way that now it doesn't balance. So if something didn't add up right on your calculator, take another look at it. Okay, so we have the same number, okay, and it has to balance. That's the whole point of the debits and credits. Uh-huh.
So just to confirm that on the balance sheet, that
I can't hear you. What?
so just to confirm that on the balance sheet, you also include the expenses on that side, like for building and depreciation.
No. I included the credit to accumulated depreciation of 50,000 on the balance sheet. That was the credit to the accumulated depreciation. The debit of 50,000 was on the income statement, it added to that total expense. So the debit went on the income statement, the credit went on the balance sheet, right? And this whole system of debits and credits keeps the assets equaling liabilities plus stockholders' equity. That's the whole point of this class, is to make sure that we understand how to use this system of debits and credits so this thing stays in balance at the end. Okay?
Yep.
So that's pretty easy, right? I mean, a lot of tedious stuff back and forth, but this system of debits and credits and using that then to what? Post, to make journal entries into my journal and then post to my ledgers, and then I just simply pull the numbers out of my ledger account to run my financial statements, don't I? Now, as you would imagine, here in the 2000s, like I said, this is maybe how it would have been done in 1960 or something, 1970, whatever. In the 2000s, we're going to go ahead and we're going to use software to do this, aren't we? Okay, so what I'm going to do, and the dicey proposition now is just seeing if I got good internet access here, is to go ahead, and now I am going to sit down, and I'm going to get into Connect. Okay, I'm going to get into Connect. Lower that. And I'm going to show you, and I'm going to get as far as I can on that same exercise that I was doing on on Canvas, right? That one I posted up on Canvas. And I probably should have had my Connect open up already, but let's see if I can find it. My favorites list is somewhat of a mess. Oh, there it is. Huh? Can you make it alphabetical? Okay. If you got any ideas as to how I can organize that, I'll give you 1 point of extra credit. Tell me how to. Okay. So now I'm in Connect, right? And you guys are what? Did I go past you already? There you are. Okay. So I click in. There it is. And I'm going to go to Chapter 2 Homework. And oh, I got to change to student view. Sorry, guys, because if I go to instructor view, it takes all the fun out of it, doesn't it? Oh, no. Don't tell me it's not going to let me in. Let's see if it'll let me in. Okay, good. And I'm going to go to question 9. And it's those last questions. You see these last set of questions down here, 9 through 13? I'm going to go through probably, if not all of those, maybe 3 or 4 of them. That's what I'm going to do next time so that when you get on Canvas on Monday, you can look at that and you can watch me do. And I'm going to get as far as I can on this one. And then I'm going to keep going with this. And I'm going to show you right now how I'm going to do it. And this is the way I recommend you view these when you look at these. Okay? I'm going to do it like this. I'm going to say, okay, boys and girls, let's look at question number 9. Okay? And then I'm going to come down, and they have these different transactions that I have to go through. And I'm going to go to my general journal. Okay? And I'm going to go to view transaction list. And when I go to the transaction list, this first one, they tell me that this Tanner invests $80,000 cash along with office equipment valued at $26,000 in the company in exchange for common stock. There's a transaction I have to look at, right? Okay, and I'm going to tell you now, pause this video and see if you can make the correct journal entry, right? And you'll pause the video, you'll do the journal entry, and then I'll say, okay, it's a little bit later now. You have to hit play again, of course. My hand won't reach out and hit play. I'll say, okay, it's a little bit later now, and what did you get? Okay, and so what's the answer here? We're getting what? Cash. So cash is an asset, so I have to debit the cash, don't I? So I click on cash, and how much is it? 80,000. Hit return. What else? Tanner, I don't know. Man, I'm in battle with the world right now. Okay, so what happens? We're sitting there, and we have what? We have this what? Equipment of 26,000. Okay, is equipment an asset? So she also invested equipment. I don't know why I'm saying it's a she. For some reason, I feel that Tanner is a she name. But anyway, so I come down, and do I have my what? Office equipment? There it is. Office equipment is an asset. So I go ahead, I put in my office equipment. It was what? 26,000. And they say that in exchange, they issued some stock, didn't they? So common stock has to be found now. I come down. Where's my common stock? Why I'm using that mouse when I could use this one, I have no idea. There's my common stock, right? And the common stock was the total of these, right? Because we got some ownership in exchange for this, right? So that's what, 106,000, right? Okay, good. So I record the entry, right? I record the entry, and then I want to come back. That was in my journal, wasn't it? If you look in my general ledger now, I should have what? I should be seeing the posting of that, shouldn't I? And just picture it now. I should be seeing a debit to cash for the 80,000, a debit to office equipment for the 26,000, and a credit on the credit side. Remember, debit on the left, credit on the right for the equipment, right? I mean, for the common stock, right? Okay. So I go ahead and I look at my ledger. There it is. Isn't that beautiful? You never want to do that stupid spreadsheet. Throw it away. Get rid of that spreadsheet. Never touch it again. If I see you with the spreadsheet again, I'm going to say, hey, throw that away. Okay? All right? We don't need that stupid spreadsheet. That's why God invented computers, is for us to be able to do this kind of stuff, right? Okay? All right, good. So we entered that transaction. Let's go ahead. Oh, wait. What financial statement is that going to show up? Income statement, statement of retained earnings, balance sheet? What do you think? Those were pure balance sheet accounts. They were just balance sheet accounts, weren't they? So there shouldn't be anything on the income statement, right? Let's see. Nothing on the income statement, right? Should there be anything in the statement of retained earnings? Nothing happened to retain earnings. It all shows where? Balance sheet. There it is, right? Isn't that beautiful? It's glorious, okay? All right, so we go ahead, and to be honest with you guys, this is the only reason I would have you purchase Connect. I don't feel there's anything else in Connect that's worth it, okay? So if you purchase Connect, this is the reason, okay, to be able to practice with this exercise. So let's go ahead and let's take a look at the next one. What time do we get out of here? 45. Great. Plenty of time. So we come over and we take a look back at our journal, and we're going to go to view the transaction list again, and we're going to do transaction number 2, and it says the company paid what? 9,000 cash for 12 months rent for office space. Is that an asset? Do we have future economic benefit? If you pay your rent, think about it. You pay your rent to your landlord for 12 months, you're good for the year, aren't you? Okay, so that's future economic benefit. So I go ahead, I click on here. Do I have a prepaid rent? There it is. Prepaid rent was what? 9,000? That's an asset, right? And of course, I had to pay the person what? Had to pay them cash, 9,000. I credit my cash because that asset is coming down, right? Okay. Okay, good. I go ahead, I record that entry, right? I go back to my oh, I forgot to say, darn it. Before I would have put in there on the video, I'm going to say, okay, guys, stop, Pause your computer. What do you think? I would write it down, whatever, or however you want to do it, or think to it. I would write it if I were you, okay, to get some more practice. Go ahead and write it down, and then you're going to come back and say, okay, it's a little bit later now, and if you don't stop me, I won't stop. I'm not going to sit there for 5 minutes and say, okay, I'm going to keep going, right? So you have to stop the thing. And then, is there anything in the income statement? No, this is a prepaid. This is a prepaid. So income statement should still be what? Should still be zero. Statement of retained earnings. Anything happen to my retained earnings? Should still be zero. There it is. How about the balance sheet? Cash should be down 900, and now we should have a new asset, prepaid insurance, right? Okay, let's see. Cash is down. We had 80. Now it's down. There's my prepaid rent, right? Okay. All right, so what I'm gonna do now, guys, I'm sorry. I'm in a bad situation. I've got into a double booking situation that I can't get out of for a couple Mondays here, and it's not something that I planned or wanted, but I'm stuck now. We are not going to have class on Monday again, but I'm going to post a video up. It'll be there Monday, and I'm going to finish this exercise, and I'm going to finish probably the rest of them, maybe 4 or 5 more of them. You'll get tired of them before I do. So it is my recommendation that you go through, and I'll say, hey, pause the video, figure out what you're supposed to do the next one, do the next one, right? And just keep going like that. And we will reconvene on Wednesday, and a week from today. And what I'll ask you to do on Wednesday is I'm going to maybe ask you to come up and show me how you did a couple of these. And then we're going to go through the chapter 2 quiz, and then we're going to jump into chapter 3. Okay? And we're going to see that chapter 3 is going to be easy for us because we've actually already started studying some of those things now. Okay, guys, I appreciate your patience. We will see you on Wednesday.
I did chapter 2 last night. Go through it again after study.
Chapter 2 quiz.
I did the
Oh, you did all the Connect ones? Oh, because you have Connect? Yeah, look at the quiz then. I would look at the quiz. Or if you want to look at anything that you were confused about there, if you were, then you might see how I handled it. Yeah, if you want to, yeah. Okay. Or you could start looking at the chapter 3 quiz. You might actually be able to answer quite a few of those questions with no problem, because I've really already shown you some of that on that exercise.
All right, perfect.
Okay.